Now we're going to be focusing on the continuation strategy. The continuation strategy is based off of continuation divergence and is primarily traded off of the daily charts. In front of us we've got the Euro USD daily chart, and the blue lines here actually show us the continuation divergences that have occurred throughout this upward trend. We're going to work through each one individually so that you can understand exactly how the continuation strategy works. If we start to begin with by zooming in and focusing in on this first continuation divergence, let's just have a little bit of a recap as to what a continuation divergence looks like. Remember, for a continuation divergence, we need to have a discrepancy or a difference between the price action and the oscillator. The oscillator of choice is the stochastic oscillator because it's smoothed for us as well, and it tends to give the best signals. For the continuation strategy, the only signals will be taken from the stochastics. We can see here we have a higher low in the price action, yet on the stochastics we have a lower low. Notice that we're looking at the %K, which is the blue line of the stochastics, the first line, to pinpoint this low point and the divergence. Again, remember, once we have a divergence actually occur, it's up to us to wait until the %K blue line flicks to the upside. Now, bearing in mind that these stochastics are actually calculated based off of the close of the bar, we need to wait for the bar to close before we're convinced that the stochastics have actually flicked to the upside. So we can see that the stochastics has actually flicked to the upside on this particular bullish pin bar here. And we can see while the stochastics here has flicked to the upside, it also happens to have crossed over the %D red line as well. So we're happy that we've identified the entry signal, or the entry bar, of this inside bullish pin bar. Now, the continuation system, or the continuation strategy, is a very similar approach to the reversal strategy, or the reversal system. We need first of all to identify the divergence, which we've done, and our entry price, when we're buying, is 2 or 3 pips above the high of the entry bar. That means we'll be entering 2 or 3 pips above the high of this bullish pin bar. So we can see that our entry price is going to be a few pips above the high of the bar there, and our stop loss is going to sit underneath the lowest low of the last 3 days, or the lowest low of the last 3 bars. Now, specifically, this strategy is based on the daily charts. However, it is still possible and profitable to trade it on different time frames, like the hourly chart, the 4-hourly chart, and the weekly charts. However, we feel that the best reward for your time invested is by trading on the daily charts. So we'll just identify the stop loss here, and we'll put the stop loss in red. And we can see the blue line here. The blue horizontal line gives us our entry level, and the red line here is giving us our stop loss level. And we have to make sure, and we've actually found these continuation divergences, and we've set up the entry and the stop for it. We need to understand that the continuation strategy actually has 2 different parts to the trade, very similar to the reversal system and the reversal strategy. We have 2 different parts. The first part of the trade is designed to give it a high success rate, which helps us psychologically. For that we use the ATR5 as our first take profit. We take the ATR5 from the entry bar in question, in this case the bullish pin bar, and as we scroll down we can see here that we're looking at an 0.0086, meaning an 86 pip first take profit. Very simply, it will look something like this on the charts. This one actually seems to be an inverse reward to risk when we're first getting into the trade. but we're doing this for that higher success rate, because the second part of the trade, we're going to be using the double buyer bar technique to trail our stop loss with the trend. So we can see here we've got the blue line here being our entry level. We've got our stop loss shown there as well, and we're risking in pips terms about 110 pips. That's from the high of the bar down to the low of the bar, but bearing in mind we've got to give it a little bit extra, around about 10 pips, because that's 0.1% of price. Now looking towards the right hand side over here, we can see that the prices are around about 122, 123, which 0.1% of price puts us on 12 pips. So our stop loss would go 12 pips underneath the lowest low of the last 3 bars here. I'll say that again. Our stop loss goes to the lowest low of the last 3 bars when we're buying. That means that rather than having the 108 pip stop loss, we've actually got ourselves a stop loss of around 120 pips. So with 120 pip stop loss and our first take profit of ATR 5 being 86 pips, we can fully appreciate that this first trade, this first order that's part of this trade, is simply designed to grab that quick first thrust in our favour and mean that we can't lose a full 1% on the trade, therefore it improves our success rate dramatically. And it also helps us a lot to reduce our drawdowns. We see here that we've hit that first take profit inside of 1 bar. And that's pretty much what that first take profit is designed to do. It's designed to capture that first thrust of anything up to around about 100 pips or so, and just lock in that first take profit, which means that we have a good success rate on this continuation strategy. So part 1 of this is to have the entry, stop loss and target. That's order 1. And order 2 simply has the order, which is the entry and the stop. So order 1, entry, stop loss and target. Order 2 just has the entry and the stop loss. Now it's very easy for us to see here what's happened. Obviously we can see that the market's moved to the upside. But let's just work through this now, actually place the orders in the MetaTrader 4 platform. I'm just going to delete these entry, stops and targets that we've placed. And we're going to go ahead and walk through the actual order placing process so you understand how we're going to do it. First of all, by hovering my cursor over the close of the entry bar, I get the information about it. I can see that it's 1.2368 and I want to enter at 1.2370. So I'll go ahead and place an entry order by right clicking and going to trading, and I'm placing a buy. Now it's a buy order. At the time this would be a buy stop. And I want to place that order 2 pips above the high of the bar, or the high of the candle in this case. And we know that's 1.2370. Which we can see neatly there has been placed in the entry order price. We also want to make sure our stop loss is in the correct position. So again, we hover our cursor over the close of that, the lowest candle or lowest bar of the last 3, which is this one here, and the low is 1.2255. 1.2255. Less the 12.5 pips or 12 pips or so underneath that. So the 55 very quickly dropped the 12 pips down to being 43. And we know that from there our first take profit on this needs to be 86 pips. So we're going to take the 1.2370 and we're going to add the 86 pips onto that. So we get the take profit of 1.2456. And we're going to put a comment in there simply stating that this is a continuation divergence or continuation strategy, and it's a long. I tend to do this on all of the different systems and strategies that we trade purely because it helps me to understand which position is which and what's running well, because it also helps when you're reviewing your trades. You can see what your continuation strategy is making for you, what your reversal strategy is making for you, and also what your swing strategies are making for you. So we've got ourselves the entry, stop and target. Of course, next you'd go ahead and work out your trade sizing. For now, we'll simply leave that as it is. And we then hit place. Order is accepted, it's okay. And we can see here the green line for the entry order, which is the entry here. We have the stop loss underneath and our first take profit. Now that's part one of the trade. And we can see here, if we're in the trade tab of the trade terminal, we've got the order there showing it's a buy order on the Euro USD, which is the chart we're looking at right now, the entry price, the stop loss, and the take profit. Now, bearing in mind, when you're placing that order, you're placing that order at 0.5% risk, not the usual 1% risk. The reason for this is we need to make sure that our total risk on the trade is 1%. So, because we're going to have two parts to this trade, this order here is running at 0.5% risk. And of course, you'd be doing that for your trade sizing. Now that we've got the first entry order in place, we now need to go ahead and place the second entry order, again at 0.5% risk. So again, we go to right click, trading, and place the buy order. And now we simply copy the numbers from the trade terminal. We know this order was a continuation strategy long, entering at 123.70. We simply copy that straight into the entry order. We know the stop loss is 122.43, which again we put into the stop loss. And notice that there's no take profit on this part of the trade, because once it hits the first take profit, obviously the trade is closed out. We want this trade to run, and we're going to be moving the stop loss. Again, we'll put ourselves continuation strategy long, so that we know exactly what it is. You don't have to go and write out the whole thing each time. I simply can see from there that's a continuation strategy long. You may choose to call it the continuation system long. And we've got ourselves everything set up. Of course, we go ahead now into the trade sizing here again, and we hit place. Orders accepted. We've now got ourselves two orders for one trade. I'm just going to go ahead now and add the comments here so that we can see it. We can see here the continuation strategy long in both parts. And we know, of course, that's on the Euro USD. Same entry level, same stop loss level, and only one of them has the take profit. Now, of course, as soon as this first bar comes along and hits the first take profit there, these orders will have both been triggered. They'll be running as live trades, and as soon as this first order actually hits its take profit, it will then actually get closed out for that first take profit. So what will happen is that order will then disappear automatically. The computer will do all this for you, of course, and the order that had, or the trade that had the take profit will hit the take profit, and you'll have one position left for that particular trade, which of course is now at a 0.5% risk, and you can see the entry and the stop loss there. What happens through there next is we then need to move our stop loss all the way through until we then get stopped out. Now, the way that we go about doing this is doing the double buyer bar, double seller bar stop loss management method. Now, obviously, because we bought here, we're using double buyer bars. So we need to look at the bars in question again, and I'm going to zoom in so we can do that. And we can see through here that once triggered and hit the first take profit, we have buyer bar, which is great. That doesn't really do a huge amount for us. We need to see two buyer bars or two bullish candles like we have here, which will actually then allow us to move the stop loss. So we've got these two bullish candles, The lowest low of these two bullish candles, of course, being this one here, and the low price is 123.41. Less, of course, the 12 pips, so 123.29, meaning that we'd then be able to move our stop loss by modifying and put our stop loss to 123.29. Modify it. Okay, the order's been accepted, and we can see that we've reduced our risk there. And that's as of the close of this bullish candle here. We've got the two bullish candles, or the two buyer bars. We've been able to move the stop loss. We get another bullish candle appear, another buyer bar. We can move the stop loss now underneath this candle. And the low is 124.30. So we'll move our stop loss 12 pips underneath that to 124.18. Again, simply by right clicking, modifying, and moving that stop loss. Now, of course, because I'm going through and actually replaying this trade, it's not going to allow me to actually modify it. But we can see for ourselves, of course, the stop loss would then be moved underneath this particular bar in question. We'll just delete that order now and watch what happens as we progress. But we can see that the stop loss order was underneath here, and we'll just draw ourselves a nice little line underneath there for the stop loss. So we can see our stop loss will be underneath that level. As we progress, bearish candle, we can do nothing. Bullish candle, we have the most recent two bullish candles. We have the opportunity now to move the stop loss. And if we look at the low of that bar, it's 124.64, less the 12.5 pips. So 124.64 becomes 124.52. We can move the stop loss underneath there now, and we've got ourselves into a position over these last few stop loss movements where we're not reducing risk, we're actually locking in additional profits on the second part of this trade. From this bullish candle, the next one takes a few more bars to appear, a few more candles to appear, but we're going to keep this in the same position because out of these last two bullish candles, this is still the lowest low. We now have another two bullish candles, and we're able to move the stop loss once more. I'm going to make this a little bit longer now, so that we can see when the stop loss is moved, we don't get stopped out by this pin bar. In fact, when we have these two bullish candles here, it allows us a small movement to the upside. And we can see through here now, we're able to then ride this move all the way to the upside, moving it again, and again to this position here. Now we've managed to move our stop loss to this position. We have bearish candle, doji. And if we look at the opening and closing of that particular bar, we can see that it's opened at 3046 and closed at 3047. It closed 1 pip higher. That doji candle there, that doji bar, is actually a buyer bar, so it allows us to move our stop loss to the lowest low of this candle and this candle here, less of course the 12-13 pips there. See how the price increases on the right hand side from 1.2 something to 1.3 something. We're then using 13 pips underneath this particular candle. Now this trade here lasted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23 candles there, which is roughly speaking 1 calendar month. But bearing in mind the second part of this trade was able to generate you a profit of 590 odd pips, it was a particularly good trade. Of course, the stop loss on this was around about 120 pips. Generating a profit of 590 is a significant reward to risk. And again, the brilliant thing with trading, as always, is that we only have to do the work once of moving the stop loss. Once we're in the trade, it's simply moving the stops maybe once every other night, depending on what happens with the candles over that period. So we've seen that trade ran there for, roughly speaking, 1 calendar month before it then got stopped out. And bearing in mind, with your continuation strategy and your reversal strategy, the only reason why you would perhaps break that stop loss management is if you get a signal pointing the other way. That is, if we get a signal saying there's a reversal divergence setting up to go short, then we'd of course go with the most recent signal. We don't want to be long on a continuation strategy and short on a reversal strategy on the same currency pair. So we're always looking at the most recent signal. Of course, we can see through this period of time that we had this continuation strategy trade run from here. We also had another one set up while we were in the first trade. Now, because this new trade set up, it's something else that we could actually take alongside this first trade. Bearing in mind, by the time this second trade set up, we're already way beyond break even. We couldn't lose on the first trade. So what we do is, we've got our stop loss. Just mark the entry level as well in blue. And let's just have a look at the stochastic here to be really clear as to when the signal occurred. First of all, we can see that we had a lower low on the stochastic. And some people may argue that that's quite a subtle difference. But the fact is, you can see that the blue stochastic line, the percent K, did go higher than the red line, hence giving us a high point here. As a result, high, low, high, low, we definitely have ourselves a lower low through there. If we shrink that back down again, we can see that when the percent K actually flicked to the upside, it was on the bullish pin bar. And that's a really nice position for us to be in, because the bullish pin bar is also, of course, a strong signal that the market's likely to move to the upside. So we're happy that our entry order in this case would be above this bullish pin bar, so we can see exactly where the entry level is. Of course, we know that the stop loss movements on this second trade would have been exactly the same as the ones on the first trade. Once, of course, we're at this position, both stop losses have been moved in the same way until they got stopped out up here. Now that means that the second part of this trade generated a profit of 330 pips. Plus you made, of course, 592 pips earlier on this longer trade, and we've got the first take profits on those. So there's significant pip gains that we're talking about here. If we look at this particular trade setup in question, the high of that candle was 126.24, pretty much 23.7 to 126.24. Our entry level is going to be 126.26. And the lowest low of the last three candles is actually this bullish pin bar itself, so the stop loss is going to go underneath the low less the 12 pips. So 125.01 becomes 124.89. And we've got ourselves our entry and stop loss there. And if we look down at the ATR5, our first take profit was 93 pips. We can see very clearly there that was hit within 2 bars. It means that we were risking about 130 pips or so, with a profit straight away of around about the ATR5 being the 93 pips. So it was inverse reward to risk to begin with, but you knew within 2 bars, or within 2 candles in this case, that you couldn't lose on the trade. You'd hit your ATR5 and you'd move the stop loss. Within 2 candles, we actually already in a position where we couldn't lose on the trade. And that's that beauty of the ATR5 and how it helps you to increase your success rates. So we've seen those 2 trades through there. We've seen the entries, the stops, and the targets. And of course, you've seen how to place the entry order as per this example earlier on in the video. Please make sure, of course, you remember when you're trading the continuation strategy and you're trading the reversal strategy, of course, they are similar, working off different forms of divergence. And while you may be risking 1% on the entire trade, you want to be risking 0.5% on each order, because 2 0.5% equal that 1% for the entire trade. As we progress through from here, we can see the next continuation divergence that sets up is from this higher low in the price action, and we have the lower low here on the stochastics. If we then look at the entry signal, we can see that the blue %K line flicks up on this bullish engulfing candle here. Now, if we look at this a bit more clearly, we can see the bullish engulfing candle gave us the setup because the %K blue line of the stochastic flicked to the upside. So we'll just be able to highlight that with the arrow. And you can probably tell straight away this was a losing trade. It only moved around 20-30 pips in favour, and of course the ATR 5 on this one was 90 pips. Now this trade here worked out as being a losing trade because we'd have had ourselves a stop loss and an entry level. So the entry would have been the blue line at the top of the bar, and the stop loss would have been this line I'm just drawing underneath for you now. So we can see the entry and the stop. We can see that the order got triggered and within 2 days got stopped out. So you'd have suffered a full 1% loss on that trade. Now, once you've then been stopped out of the trade, we're looking back at this new, bit of a doji candle really. But the fact is that the conditions are still true for a trade. We still have the %K flicked up and pointing to the upside. We still have the continuation divergence in play. So we'd actually go ahead and place the entry order and stop loss for this bar in question. The entry order, of course, 2 or 3 pips above the high because we're looking to go long through here. And it's 2 or 3 pips above the high of this candle here, which is the entry candle. The stop loss is 12.8 pips, so pretty much 13 pips underneath the lowest low of the last 3 bars, the last 3 candles, which we can see is actually the current candle. So we're actually risking in this case 150 pips or so, with our first take profit being 104 pips, which we can see did get hit. If we look at the price action and look what happened throughout the trade, we got triggered into the trade by this bearish pin bar. And at that point there, you'd be starting to get a little bit scared that perhaps you're going to get stopped out again. A lot of people there would be tempted just to close the trade out just to reduce their risk. The fact is, the trade set up, we need to follow our plan and follow the rules. After that bullish candle, which is actually that bearish pin bar, we have ourselves a bearish candle, which is hardly surprising really, followed by a strong bullish candle. And it's this bullish candle here that gets us most of the way to target, but it also allows us to move our stop loss. Now, because we have actually had 2 orders still running here, when we place the entry order here, we have 2 entry orders, both running at 0.5% risk. Entry order 1, of course, would have that target as well of 104 pips. Entry order 2, of course, would not have that, but they both have an entry and a stop loss, which means there's 2 stop losses that would need moving. Order 1 and order 2 of this trade. And we've been moving the stop loss from where it is to underneath the lowest low of the last 2 buyer bars, less than 13 pips. So we can see what we've done then, actually reduced our risk down on both trades to about 75 pips. And that happens as of the close of that strong bullish candle. As the next candle appears and hits the first take profit, we can see there that order 1 is now closed out for its 104 pip profit, which is great, because it's one less thing we have to manage. We haven't got to manage the stop loss. But now that we've got order 2 still running on its own with no target, we of course have to move the stop loss. We move it to underneath the lowest low of these 2 bullish candles, hence reducing the risk that little bit further. Now the brilliant thing here is that even if this trade then gets stopped out, which I think we can all see, of course, it does get stopped out, we still win on the trade. Because while we lost around 50 pips on the second part of the trade, we made 104 pips on the first part of the trade. So it's still actually a profitable trade. Yes, we lost the trade before that, but we definitely made money on this trade here. Now you'll notice that some of these trades really fly, like some of these examples through here. And others like this one here kind of stall, go sideways a bit and don't really make as much money. Certainly this last example we've just worked through would be a losing trade here, followed by a small winning trade. The two previous ones were two fairly decent sized winners. But the interesting part here, out of 4 trades, we've only got one losing trade, which psychologically is very good for us to be able to trade. And also, if we're looking at the reward to risk on the 2 big winners is far in excess of a 1-to-1 reward to risk. And this small winner at the end here, yes, it's been a small winner which drags down the reward to risk, but it's still been a winning trade. If we didn't use the ATR 5 there, it would have been a loser. As we move on and look for the next continuation divergence now, we'll shrink this back slightly. We see where we've got it highlighted over here, we have the higher low on the price action, and we have the lower low on the stochastics. And when the %K blue line flicks to the upside, it beautifully coincides with this bullish pin bar. Now we can see, of course, price again has run a long way to the upside. So we're going to work through this and look at how we'd have placed the orders and so on. Once we know that the bullish pin bar here has got the stochastic to flick to the upside and give us the entry signal, we're going to go ahead and place both of our orders. Of course, both orders have the stop loss. The prices are right now around 1.3, so we're going to use 13 pips underneath the low of this bar. And the entry, of course, as always, 2 or 3 pips above the highs. So we've got ourselves the entry order there, and the first take profit on this one is 106 pips, around the 1.32 level. Let's measure that. Quite right, there we go. So we can see that we're looking to take our first take profit of 106 pips, and our risk is actually around about 100, 105 pips. So we're looking at a 1-to-1 on the first trade, which is great. And bearing in mind that this is only half the trade. This trade has 2 orders. Order 1 has the entry, stop loss and target. Order 2 just has the entry order and the stop loss. If we work through this, we can see it actually took 4 candles until the ATR 5 first take profit got hit. And throughout that, we'd have been actually keeping our stop loss at this level. We'd have been triggered into the trade with both orders. Price pulls back, we can do nothing. It's not until this big, strong bullish candle here that closes on the highs that then we have 2 bullish candles that allow us to move our stop loss to underneath the lowest low of the last 2 bullish candles, less than 13 pips. And it's at this point here where we've made 106 pips profit, and we've also got ourselves to a position whereby our risk now is less than 100 pips. It's about 85, 90 pips tops. So we've got ourselves to a position where we can't lose on the trade as of this point here. We then, of course, get another bullish candle, which allows us to move the stop loss once more, and we get another bullish candle, which again allows us to move the stop loss. The stop loss will be sitting underneath this candle here, about 13 pips. So we can see it doesn't sit slap bang underneath it, we give it a little bit of breathing room there. Now, as we progress through from here, we see bullish candle, bearish candle, bearish candle, bullish candle. We've got 2 buy bars or 2 bullish candles, time to move the stop. It goes 13 pips underneath here now, which is around this level here. Certainly we can see at this 13 pip level, we have not been stopped out of the trade. We get to hold on to the position. So bullish candle, bearish candle, bullish candle. The stop loss still stays underneath here. Bullish candle, bullish candle. Actually, the low of this candle here and this candle here is pretty much exactly the same level. Stop loss is staying underneath this consolidation there. Bullish candle, stop loss still holds its position. And bullish candle, it's now time for us to be able to move the stop loss underneath here to lock in some additional profits. We can see the price wasn't moving sideways through there before it broke to the upside. Really good example of a consolidation breakout. And if we zoom in a bit closer now, we can actually see that there was a high, a low, higher high, high, low, high, low. We've got a lower low in the oscillator again, and we actually have ourselves here a higher low on the price action. So on this bullish candle here, we have ourselves another entry signal to the upside. What that means is we place an entry order above the bar here. We've got our stop loss for the first trade underneath that level. Our stop loss for the second trade holds underneath this one here. Of course, bearing in mind this is a new trade that we're looking at taking here. We're still in the first one, but the new trade, the stop loss goes to the lowest low of the last 3 bars. So underneath here. We can see through there, the trade does get triggered. It takes a couple there before it actually does get triggered. It doesn't actually get triggered straight away. We can see that was actually then a bearish candle. So the entry order gets moved very slightly across. And of course, the interesting part here is both stop losses would now be in exactly the same position. So the stop loss on the trade that's running sits underneath this candle here. And because of this new entry order, the stop loss is staying in exactly the same position there underneath this bullish candle. So when we tried to place this order, the stop loss was underneath here. Now it's on this one here. We're putting the stop loss underneath that bullish candle. We can see we've been triggered into the trade. Trades close slightly in a profit, and the stop loss can now get moved for both trades to underneath that level there. So we've reduced the risk on this second trade. The first one's still running in a healthy profit. Now, of course, when entering this second trade, that's not to be confused with the second order. When entering this second trade, the ATR 5 is looking at 97 pips. So we'd have ourselves a take profit way up here of 97 pips. Which is around this kind of a level here. Just measure again. There we go. And we get this next bullish candle appear, and both stop losses are allowed to be moved again underneath this bullish engulfing pin bar. Price is still moving up, and again we're able to move our stop loss underneath this bullish candle. We've actually now hit the take profit, so the first take profit of this second trade. So this trade here has hit its first take profit, and with this bullish candle here, we can move both stop losses again. So understand now that the stop loss from this trade is now right up here, currently sitting in a profit of around about 435 points, and this second continuation system or continuation strategy trade is running in a small profit of about 50 pips. And that's actually where the trade then gets stopped out. or both trades actually get stopped at that position. We see that we have this order here, making us the 435 pips or so, and the second made the profit of about 50 pips. Of course, both trades hit their first ATR 5 take profits, which means that, again, we have another 2 winning trades. What's interesting looking at through here now is out of the 1, 2, 3, 4, 5, 6 different trading opportunities, we've only had the one full-size loser. We've had a small winner here and a small winner here. We've had 3 big winning trades. So 3 big winning trades, 2 small winning trades, and 1 loser. We can see how that success rate is very good for our psychology, and we can also see how those big winners are going to help to grow our account. You're probably starting to understand now that the continuation system and the reversal systems are very similar. Of course, it's just the type of divergence that actually then shows whether or not it's a reversal systems trade or a continuation system trade. The actual approach of the entries, stop losses, first take profit, and trading stop loss are identical. And of course, if we get a signal pointing the other way, we go with the latest signal. So if we're in a continuation systems trade and the reversal sets up, we of course move our stop loss and get ready for the reversal systems trade. So just start to understand how they're going to get sometimes one trade into the next, depending on what sets up on the charts. Really interesting thing through here now is we're not actually looking at trend per se. We're looking at trading movement, or almost phases of like cyclicity. We're not looking to trade trend because continuation divergences most of the time do set up in trend, but not always. Sometimes they can actually pick the absolute turning point for you. But the interesting part is that however they set up, the continuation system should be used to trade them. We're going to have a look now at the Euro Yen. We're going to have a look at probably the best trade I had through 2012, and it was a continuation divergence trade. Now, we were in this strong upward trend moving up, and we can see through here that, of course, the market did actually move into a downward trend. I'm going to do this bar by bar on this one so you can really get a flavour as to how it's going to work out for you and what we actually see. So we can see how price consolidates into this symmetrical triangle or consolidation at the top here, then breaks to the downside. And we can see that we have ourselves, looking at the stochastic, highs, highs, lows, and lows. So lower highs, lower lows. We've got convergence, not divergence, on everything we see so far. We now see that we have ourselves a lower high in price action, but a higher high on the stochastic. What that does is that tells us that a continuation divergence for the short side setting up. And of course we can see that the %K, the stochastic blue line, has flicked down in the direction we're looking to trade. Therefore, we're looking at a short entry order now. So our entry order is going to go underneath this bearish candle. And the stop loss goes to the highest high of the last 3 bars, the last 3 candles, which is highlighted there for us. And the first take profit here is going to be 1.0212. Bearing in mind we're trading a yen cross here, the 1.02 means 102 pips. So we can see here the first take profit is around 102 pips. And straight away we can see that this order was not triggered. You can see the lows of these 2 candles are exactly the same level. We weren't triggered into the trade. What that means is we need to then go ahead and cancel all these orders and replace them for this bullish candle here, because the stochastic is still pointing down to the downside, giving us the sell signal. Now, rather than cancelling and replacing them, we can actually see that the stop's going to be in the same position. The entry order is pretty much going to be in the same position. And the first take profit, rather than being 102 pips, is 103 pips. So it's pretty much exactly the same trade here. Of course, bearing in mind, we're splitting this trade into two parts. We have two orders. Again, we know here that this was not triggered. Price kept moving to the upside, yet the stochastic is still telling us it's going to be moving down. Okay, that's fine. We can go ahead now and actually cancel these orders, and we're going to replace them now on this small little doji bar. To our entry point, our stop loss is behind the highest high of the last three, which is going to sit just behind here. And our first take profit now is looking at 96 pips, so it's a smaller take profit. So 96 pips puts us with a first take profit around this kind of a level, and our stop loss was 62 pips plus 11 pips. So it's 62 pips that we can see on this price ruler, but we can see that with the euro yen the price is 107, or if we're going to be doing the stop loss methodology, that's 10.7 pips, that's 0.1% of price, 10.7, 10.8 pips. We'll of course use 11 pips behind there. So rather than us having ourselves a 62 point stop, we've actually got ourselves an extra 11 pips on the end there. So it's going to be around about the 74, 75 pip stop loss level. So a 75 pip stop loss. And sure enough, we can see that we've now been triggered into the trade. The order's been filled, we're in the position. And we have ourselves another bearish candle, which very quickly allows us to get that stop loss moved. And we're reducing our risk on both orders, on both parts of this trade. Inside of 3 candles, we've had our first take profit, which is great. So we've already managed to bank some profit there, and we've still actually now got ourselves to a position where we've got half of the trade still running. Stop loss gets moved slightly to the highest high of these two bearish candles. Bullish candle appears, we do nothing. Bearish candle, we can now move the stop loss down to this level here. This pin bar opened at 44, closed at 43. That's actually a bearish candle, but of course the highest high of these two bearish candles is still up here. Strong move down, stop loss moves, and this is actually quite an interesting point here. We have ourselves a bullish pin bar with a lower low on the price action, but a higher low on the stochastic. We actually have ourselves now a reversal divergence setting up to the upside. What that means is we take the stop loss from where it is, rather than being 11 pips behind this now, we put our stop loss just above this bullish pin bar, because we'd now be looking to take the long reversal divergence trade. That means we go ahead and place the new orders for this reversal divergence trade to go long. Now, as it happens, I know that this then doesn't trigger into the trade, but that doesn't change the fact that we would have actually moved the stop loss down and placed the entry orders for that long divergence reversal trade. After that, we have these two bearish candles, although stop loss still stays in the same place, because behind or above this bullish pin bar is the same area as where the stop loss would be. Of course, the stop loss now goes back to that double seller bar routine, which would be about 10 pips above the high of that candle there. And looking at this, we can still see this line, this blue line, pointing to the upside. So we would actually be cancelling the orders for the reversal divergence and replacing them again and replacing them again. So let's be moving the stop loss down each and every bar through here and placing long orders for the reversal systems trade to the upside. Now that it's pointing down, we'd leave it where it is. Because of the fact that the blue line is now pointing to the downside, that means that the reversal divergence is no longer valid. The stop loss stays where it is. And that's going to be about 2 or 3 pips above the high of this bearish candle, because we were looking to go long there. Therefore, we move the stop loss to that level. Now that we have the stochastic pointing down again, and this reversal divergence is invalid now, we have bearish candle, we move our stop loss down to the highest high of the last 2 bearish candles, plus the 10 or 11 pips. Price keeps moving down, we keep moving our stop. Bullish bar, do nothing. But this is a bullish bar, even though it's a bearish pin bar, or a high test bar. So it's a bullish candle, we still do nothing there. We wait, we have 2 bearish candles, we move the stop loss. We have ourselves now another bullish candle, we do nothing. Even though the stochastic's pointing up again, the reversal divergence is not valid because it's lower lows on the price action and on the oscillator. Price pulls back again, we're still not in the position. And we have ourselves bearish candle, time to move the stop loss. Bearish candle, time to now move the stop loss. And the interesting part here is we have a higher high on the stochastic and a lower high on the price action, meaning we'd actually now be looking to sell underneath this strong bearish candle. That means we'd have ourselves an entry order underneath here, looking to get short, and stop losses for the first trade, obviously we know it's there, and the stop loss for the second trade will be in exactly the same position. The trade triggers in, both stop losses get moved, bearish candle, we move the stop again, bearish candle again. But of course, the highest high of the last 2 bearish candles or seller bars here is still in the position that the stop loss is currently in. Price keeps moving down, we keep moving the stop loss. Price keeps moving down, we keep moving the stop loss. Of course, bearing in mind there have been 2 orders on this particular trade here in question. Our first take profit here was 130 pips, 129.7. And we can see we'd have hit our take profit on this big bearish candle here. So we have one trade running heavily in profit and another trade that's hit its first take profit, and the stop loss is now moved to around a break-even position. We then got ourselves this bullish pin bar here, if you can see. And the interesting part here is if we just zoom into the stochastic, we actually now have a higher low on the stochastic, an obvious lower lows in price action, and the stochastics flipped to the upside, which we've got ourselves now to a position whereby it's a buy signal. So the stop loss moves down to here, 2 or 3 pips above the high there, where our entry order is going to be for the long reversal systems trade. And that's the point that we then get stopped out and triggered into the long reversal strategy. And what's interesting through here is we had a 75-point stop loss, and we managed to achieve a profit there of over 950 pips just on that one trade. That's more than a 10-to-1 return, which is a huge reward to risk off of that trade. Of course, bearing in mind it's a 10-to-1 reward to risk off of 0.5%. So it's more like a 12.5 to 1 reward to risk. But we actually only achieved about 6.5% return because we were running 0.5% risk in order to get that high success rate. I must point out, you don't get 1,000 pip trades crop up all that often. In fact, I actually closed this trade out on this bar prematurely because it was a 1,000 pip trade and managed to bank 1,026 pips out of that trade. And I closed it out around here You can see around the closing price of the candle, purely because of the fact that it was a 1,000 pip trade. And this second one we can see here as well, this second order, this second trade, managed to achieve a profit of about 170, 180 pips, nothing to be upset about at all. It was a bigger stop, it was about 280 point stop loss there, but we still made money out of the trade. The fact is, out of these two trades, he banked well in excess of 1,200 pips. That's a huge return from two trades. Now granted, this first trade up here did take a month to run to get to that position, but 1,000 pips in one trade, you're not going to be too upset. But this should quite clearly show you now how we go ahead and actually place these orders and stop losses and the first take profits. And of course I showed you how to place the orders, which of course is 2 orders for each trade, back at the beginning of this video. Just to make sure that you get to see that now for the short example, we'll do it on this one up here, so you can see more clearly what happens. We first of all need to know the low when we're selling, which is 107.10, less the 2, 107.08. So it's a sell, it's 107.08. The stop loss was the highest high of the last 3 bars. The highest high of the last 3 is this one here, and the high of that is 107.795, 107.80, plus the 10 pips, which means 107.90. And the first take profit on this would have been, if we look down at the ATR5, 96.97 pips, so 106.12 for our first take profit. And we know that this was a continuation strategy short. Of course, the next thing to do is to risk 0.5% on this. We go ahead and work out the trade sizing, and once we're happy, we then hit place. Place successfully, we hit OK, we're happy with the entry, the stop loss, and the take profit. If we look at the trade terminal, we can see that it's been placed. We're happy with it being placed there, and of course we understand that that is part 1, or order 1. We need to go ahead and place the second one now, place another sell, and the way that we do that is to copy the numbers from here. The entry level is the same at 107.08, 107.08. The stop loss is the same at 107.90. There's no take profit, and the comment stays the same there. Continuation strategy short, continuation short, continuation system short. Just name it something so you understand what's going on there. Understand that again, trade sizing is 0.5%, so whatever you risked on your first order, you'd be risking again on your second order. There's no take profit on the second order because of course we're going to be trailing the stop loss. Place it, it's accepted, and we can see sure enough through here we have ourselves 2 orders for one trade, entries and stops at the same place, and one of them's got the take profit. We've seen how to move the stop loss, we know how to do that, and of course we're fully aware that when the first take profits hit, this one here closes itself out, and we only need to manage that one order. Now that we've seen both long and short examples of the continuation strategy, it's time that you actually go back and use the trading simulator. You don't want to be doing this bar by bar necessarily. You actually want to do this on the trading simulator and just try to replay at least 1 year's worth of data for a couple of different currency pairs. Bearing in mind that every single currency pair that you choose to trade will achieve different results each year, so pick a couple of different currency pairs and look at what results you get over the year-long period. The nice thing about that trading simulator, of course, is it will actually record the results for you, and of course, it will give you an equity curve of the results as well. Take some time to do that now before moving on to the next section, because I want to make sure you understand exactly how the reversal and continuation strategies work before we move on to the swing system.